All right, everybody, welcome back to the show. So happy to have you here today because I haven't done a podcast in a minute. It's been a few weeks, so if you're tuning in, thank you. I appreciate you doing so. So I've talked about the pre-approval process beforehand, but it's just so important, and I want to reiterate a couple of points, some of the ones that maybe I didn't talk about in great detail in the last episode. First of all, I want to say this. We can make buying a home an emotional decision, and that can be very risky. It can have negative consequences. The good news is we don't have to do this. There's a logical flow to buying a home. And one of the first steps in that flow is getting pre-approved for a mortgage. You should do this even before you really start viewing homes. The reason is that way you have an idea of what you can spend on a home. And if you happen to go into a property and you decide, wow, I really love this, I want to write an offer, you're in a better position to do so. And secondly, you don't necessarily want to write an offer for a property that you can't afford. You don't want to later learn once you're under contract that, oof, I actually can't afford this home. It's going to put me in a tough financial position. You don't want that to happen. So to prevent that, start by getting pre-approved. And I'm going to talk about several different factors that do affect your pre-approval because it's not just income. There are several things that the lender will take a look at to determine what you can be pre-approved for. And that's what we're going to talk about in this episode. So let's do that. There's really four different points I want to talk about, but they kind of fit into two categories. I think the first category is going to be related more so to income, what you make. And the second one is going to be related to your debts. So let's talk about the first of the 4 points. So how much you make, your income, your gross income. This is a significant factor in determining what you can afford for a house. Most likely the greatest factor. Lenders want to make sure that you actually are bringing in enough money on a consistent basis to afford the house that you're planning to buy, right? Consistency and stability, some of the biggest things that they're looking for. But it's not just your income from your jobs. It might be a side hustle, it might be a salary, it might be a bonus. So it's not just your weekly paycheck. There are other things that can go into this. The second point that I want to talk about that's also related is the down payment, right? This is the initial upfront amount that you put down or that you use to purchase your home. Now, the amount that you're willing to put down can affect your pre-approval. It might also affect your rate as well. So you might, depending on your situation, not have a ton of money to put down, but make a lot on a consistent basis. Maybe you bring in over whatever period of time you get paid, you're bringing in a good amount of money consistently. Well, then that might be okay. Or you might think, I want to put more money down so that my monthly payments are less. You have that option as well. So when you meet with a lender, they'll explore that with you. They'll go over what you might be able to do and what you can't do, what it's going to look like if you put 5% down versus 10% versus 20%. So that's very, very helpful. That's really all I have for the first 2 points. Pretty straightforward with that. Now let's take a look at your debts. So the lenders will take a look at your debt to income ratio. So it's literally taking your debts and dividing it by how much you make. There are percentages that they can work with to determine what you can get pre-approved for. So what we're looking for with this ratio, this debt to income ratio, is a smaller number. The smaller the better, right? You want less debts for how much you make. So there are several things that you might be able to do to improve your DTI. First of all, you could lower your debts. You could maybe pay some of them off, whether that's student loans, credit card debts, personal loans, whatever it might be. Or you can increase your income. Obviously, both are not the easiest thing to do, so you would have to be diligent with doing that. But taking care of that can affect your pre-approval in a positive way. And then lastly, related to this is your credit score, right? They want to make sure that you're you're making payments consistently, that you're not maxing out tons of credit cards. That's not going to look good for your overall financial health. So you want to be consistent with this, right? Consistent and stable. In short, there are certain things they say, maybe there's an optimal amount of debt that you should be in with a credit card. I don't know too much about that. I would ask a lender, and they likely will be able to provide you with more information. But really comes down to this: make sure you're making your payments on time, and don't go too much into credit card debt, whether you're getting pre-approved for a loan or not. It's pretty crazy how quickly that can add up, right? It's maybe you have not a financial card. Maybe you have a credit card to help you in case of an emergency or in case of some financial struggle, but can quickly get out of hand if you just start swiping that card. So be careful with that, and know that it's a way you can improve your pre-approval if you're not in the best financial position with your credit score. So those are several different factors: your income, your down payment, your debt, and your credit. If you meet with a lender, there's a good chance they're going to take the time with you to help you take all of these into account and offer suggestions to improve your situation if necessary. So again, the earlier you can do this, the better. Let's say you're thinking about buying a home a year from now. I would do it. 6 months from now, I would do it. 3 months from now, I would definitely try to get that taken care of as soon as possible. So again, never hurts to get ahead. Doesn't cost you anything. So if you're just thinking about it, not sure if you want to rent for a couple more years or if you want to take that next step and become a homeowner, still do it. It's just a simple way it's easy to apply. A lot of the companies that do this, whether you go through a larger bank or a more local organization, you can just apply online, and they can get you that pre-approval pretty quickly. So knowledge is key, right? We don't want to make emotional decisions. We want to do the logical thing. And that's the first step. That's one of the first steps: getting pre-approval, knowing where you stand financially, and whether or not you're able to buy a house. So that's all I have for this episode. Thank you again for tuning in. It's a beautiful day. I hope it's a beautiful day when you're listening to this. Take care, and I'll see you on the next episode of the show.